Welcome back, my awesome people. Now, today I am honored to be sitting here with Sal Gilbertie. He is the CEO and founder of Teucrium. Now, Teucrium is a very different set of ETFs that they hold compared to what we've had on this channel. We're going to be looking at the commodity sector. So things like sugarcane, things like wheat, soya beans, corn. And I know many of you, my audience members, are trying to diversify your portfolio with alternative ETFs. And that is why I am so happy to be here with Sal. So Sal, how are you doing today?
Doing very well. Better, all the better to be here with you, Jacob. It's fun.
I appreciate it. I know it's a very busy time of the year, and it's also, beautiful day where we are. So I'm sure right after this, you'll be able to go outside and enjoy the weather. So let's get right into it. So Sal, tell us about yourself. What first inspired you to get into the world of commodities, ETFs? Can you tell us the history of Teucrium?
Sure. Very long time ago, I got into trading right out of college. A company called Cargill hired me, and they're the world's largest grain trader, world's largest privately held company, I think. And I traded oil for them, and they're of course the largest grain company in the world. And I learned a lot from that, and through a variety of careers. I made a career of trading commodities, basically. And commodities fascinate me. I'm a simple guy. I'm really a lousy stock picker. Don't know how to do it. There's too many variables. It's not just, does it have a good product? It has to be good management. A lot, the economy's got to be good. Commodities are really simple. There's either enough or there's not. And so if there's enough, the price goes sideways at the cost of production generally. And if there's not, the price goes up, and it generally goes up pretty quickly, and there's a lot of volatility, and it's good fun. So I was running a renewable fuels desk out of Societe Generale, SocGen, because I had invented or developed the ethanol contract, the ethanol swap contract, back when ethanol became popular as an additive in gasoline here in North America. And so somebody, I was called to another person's office because they wanted to get a futures account. I was trading for the house, and it turns out it was the guy's opening USO. And I was amazed. I thought, wow, I could never trade oil for my own account because I was trading other people's money and it was a conflict of interest. I couldn't trade futures because I was trading futures for the house. And these guys had something called an exchange traded fund, which I'd never heard of. And they were putting oil in it, and I could trade oil in the New York Stock Exchange. I thought that was the greatest idea I ever heard. But then I said, well, wait a minute. What if, where are all these ETFs? And there really were only gold and a couple of oil and natural gas ETFs. There weren't anything else. And I couldn't believe that there were no grains ETFs because, in my mind, the last thing any of us will do is let ourselves, our families, our friends, and our animals go cold or hungry. So if you're not involved in energy or food, as a base of your portfolio, I just don't understand that really. And so I started Teucrium to launch better oil and gas ETFs, which we did, but no one bought them. You have to be first in this business, and we were third and fourth to market in them, respectively. So and we were the first grain funds. Our first fund was corn, and the ticker is CORN. So, it was a great ticker. It was the first thing and still the only fund that just has corn in it. The only exchange traded fund that just has corn in it, unlevered. And so we started corn, soybeans, wheat, sugar. I think, cane is what our cane fund, and that's the ticker, cane, CANE, is what brought your attention to me, Jacob, and I'm grateful. But that's what happened. Then we got into crypto later on. We could talk about that, but we were one of the first to file for a Bitcoin futures-based fund. We were the first to get it approved in 33 Act. It's kind of getting into the weeds, but that's why Grayscale won their lawsuit. They used that approval to wave at the SEC and the courts and say, hey, if you can approve this one, you can approve us. And the court sided with them, and they were right. So yeah, we broke some ground in crypto, and it's fun. Our specialty is derivatives-based ETFs, and right now we have agricultural ETFs and one crypto ETF.
That is the difference between commodity ETFs and any other ETF, as you said, right? Commodities is pretty simple, straightforward. It's either there's not enough or there's more than enough. And especially by hitting the ground first, because personally, I have never seen a pure play ETF on the commodity sector. And I think this is amazing because currently in the food shortage, the food surpluses globally that's happening is, making food science progress a lot faster. It's also making agriculture expand and find a variety. So I think this is actually a unique ETF. And so now let's look at the flagship and groundbreaking ETF that is currently right now changing the game because we have RFK Jr. making policies in the White House that is eliminating or reducing high fructose syrup, corn syrup, and reverting to more natural sugars. And Coca-Cola just recently said that they will be swapping their corn syrup with sugar cane. So can you tell us more about your ETF, the Teucrium Sugar Fund, ticker symbol CANE, and how did you decide on the holdings?
Sure. Well, so we launched these funds all within a year of one another. We started with corn, as I said, and then we launched wheat, soybeans, and cane all on the same day, I think. And that was quite a while ago. But, people don't really pay attention to anything until it's in the headlines. And so sugar's rarely in the headlines. And now that it is, that's really good. We happen to, be the only sugar-based ETF out there. And the ticker's great, of course, with cane. But what's interesting about the sugar markets is that the United States has always had a very protected sugar market. We have since 1934, U.S. sugar markets have essentially been closed in terms of, you can import sugar, and we do because we use more sugar than we grow. And so sugar's produced from sugar cane and from sugar beets. And I think cane has the edge, but the U.S. is as close to 50-50 most years as you can be, where half our sugar is produced with cane and half our sugar is produced with beets. But we only produce, and I'm guessing these numbers, okay, because from what I remember, but we produce about 9 million metric tons of sugar, and we use about 12 million metric tons of sugar. So you have to import the other 3. Now, sugar in the United States trades substantially higher price than sugar outside of the United States because of subsidies and taxes and favorable loans that will help sugar producers in the United States. And so you in essence, tariff markets on sugar is nothing new for those particular markets. The U.S. has always been a closed market to sugar. It's very, very expensive to bring it in. And so, but you have to. Okay. So what happened was unintended consequences. In 1934, when they decided to protect the sugar industry to keep U.S. prices higher than the rest of the world, and they almost always are. Okay, we're 50 to 100% higher sometimes. Sometimes we're double the price of global sugar. We're not right now, but we are much higher than the price of global sugar. So we decided to go global with the fund. The fund holds ICE sugar futures, and that's the International Sugar Futures Standard because it's a freer market. Okay, the U.S. is not a free market in sugar. That said, to your point, when Secretary Kennedy is trying to discourage the use of high fructose corn syrup, the reason high fructose corn syrup came into being as a sugar substitute was obviously, people producing corn are trying to sell byproducts from corn, but mainly was the protectionism that the United States put in place in 1934 because it made high fructose corn syrup about half the price of sugar in the U.S. So any candy maker or heavy sugar user in any food that has sugar in it, they're going to obviously go with the cheaper product. And those that can go with the high fructose corn syrup. Now, the complication here is that I saw the headlines just like you, and it looks like, it looked to me like Coke was going to replace sugar with high fructose corn syrup with sugar. That would be really hard to do. They'd have to change their machinery, change their recipes, change everything. They're not going to do that. It turns out they're going to come out with a new product, much like Mexican Coke in Mexico, Coca-Cola in Mexico has real sugar in it. And so Coke is going to come out with a Coca-Cola in the U.S. will come out with a Coke product that has real sugar in it. Will that increase the demand for sugar? Yes, it will. Will it increase it enough to move the price? That's still uncertain. That said, if a lot of other companies decide to, acquiesce to Secretary Kennedy and stop using, or at least offer alternative products that use real sugar versus high fructose corn syrup, and there's debate there. All of us can say none of it's good for you, but it depends on your choice. It doesn't take much in the sugar world, both domestically and internationally, to move the price when the supply-demand imbalance gets imbalanced. And so if more than just Coke comes out and says, you know what, we want we want to do that for whatever reason. Is it political, to look good politically, to look good in the press, to look good because they want to do it to certain people who don't want high fructose corn syrup or want regular corn syrup? All those things are going to factor in. And if enough companies come in and say, we really want real sugar made from cane, that will drive the price, that will affect the price of sugar. It may cause it to go higher, and that will be international sugar. So the international sugar price, which our fund holds, because that's real cane sugar, that likely will move. But there's no way to tell right now if that's going to happen or not. Sugar, you can keep an eye in general on sugar supply demand. It's generally within a thousand metric tons of balance. And so, we use whatever, 100, 110, 112 million metric tons of sugar. You're generally out of whack between 2 and 7 million metric tons. That's a pretty thin razor. And so on years you see sugar go up, you look and you say, wow, the imbalance wasn't bad. It was 2 million metric tons, but it was 2 million metric tons. That means the world used 2 million metric tons more sugar than it grew. Price went up. That happens all the time. Conversely, if the world grows more sugar than it uses, the price goes down. And sugar's right about in the mid-range of where it's been recently. There's a guy named Andy Hecht. He's a famous commodities trader, and he writes a lot for Seeking Alpha. And he always tells the story famously. I love being with Andy because he says he worked for Phillips Brothers back in the day. I think this was probably in the 70s or 80s, when sugar was trading 2 cents a pound. And he wanted to buy sugar. He saw something that made him want to buy sugar. And he went to his boss, and his boss said, why should I let you buy something, put the company's money on something you get free on any restaurant table in a little packet? And well, sugar went to 77 cents or something. So he would have had a stunning 35 timer on his money, but his boss wouldn't let him do it because it was free. Different world now. Sugar's different pricing. But yeah, I would keep an eye on things. If we do go out of balance, the price of sugar could go higher, and we do have, thankfully, the only sugar ETF that's out there.
And that will, of course, in return, elevate cane's appreciation price. And I think that's what everybody would be looking for. And I think to stay on that point, I do see a major difference between the Coca-Cola in Mexico and the Coca-Cola that we have here, because it's like a different type of sweetness. And I think when it comes to Coca-Cola, of course, not changing their whole system, but providing it as a second type of drink, I think it will capture the audience. And I think with other companies, once they see, okay, so natural sugars are increasing profits for Coca-Cola, who knows, they might jump in as well. And so because you said that commodities can go up and down and they fluctuate, does this mean that CANE is more of a long-term hold? And can you tell us more about that strategy? Because even looking through your ETF suites, there's a few 2x leverage ETFs as well. Can you tell us more about that?
Sure. So let's set the 2x aside. 2x should only be traded daily, and that's a different thing. They should not be bought and held. If you want exposure to something, and you said in the beginning, some of your audience are looking for, low correlation assets. They want to diversify a little bit. That's really good. And commodities do that. And the grains in particular are generally, if you take all the commodities that trade in ETFs, which I think is a couple of dozen, and chart them out over long periods of time, 10 and 20 years, the grains very often are in the bottom quarter of those, literally, in terms of correlation to the S&P 500. So you really want something like that. The sugar fund, it's going to depend on what happens here. The world supply demand balance is a little bit, it's right there. It could go either way. And so I think that if, to your point, a lot of other companies and the Coke product catches on, Coke, they saw their mistake with the Coke Classic, that whole fiasco of changing the recipe completely. They're never going to change a whole recipe again. They're just going to come out with a new product, see how it runs. That makes sense. But commodities are different. And I'll shift gears a little bit and use corn as an example. Okay. And there's something that people can look up called the golden grain cycle that we've written. And there's something very unique about, agriculture, and that is that it's subsidized in every country of the world. The last thing any country wants is to run out of food. It's people will then throw the leaders out of power. And so every government in the world subsidizes their farmers. So farmers get used to operating at break even, believe it or not. And so corn's a really good one because the charts are easy to see, the spot continuation charts. And if you look at the golden grain cycle. If you look at that, there's some charts there. And my company puts it out. Our lead analyst, Jay Canley, wrote this. And it's a really good example of what happens with corn is it will trade at break even, which since the 2006, 2007 change of ethanol going into the fuel supply, break even for corn has been a futures equivalent price of approximately $3.50 to $4 a bushel. And what has happened in the last, I think we're going on 17 years now, since then, 18 years. 3 times in that 18 years, corn has doubled from that $3.50 to $4 level and gone to between $7.50 and a little above $8. 3 separate times. Because what happens is the break even is the break even. It's between $3.50 and $4. Farmers are subsidized to plant. They'll plant, assuming the weather's good. There's enough corn, and farmers will just plant something else the next year if they hit their break-even price. So you have really historically very limited downside. And so we actually had a financial advisor call us up one day and said, I love your corn fund. Well, why? Well, when I see corn around $3.50 to $4 a bushel, I weight it into my portfolio, WEIGHT, and then I wait. And then when there's a drought, I get out. He said, I wait, drought out. Because he said 3 times in the last 17 years, this guy did it. And the fund may not double like the futures prices do, but it goes up when the futures prices goes up and down when the futures prices go down. But he said, look, if I put 1% of my portfolio in corn when it's at around $3.50 to $4, and a client comes in and says, what am I doing in corn? And corn price goes down 10%. And towards $3 a bushel, which it rarely does, and won't stay there because farmers will not plant. He said they lose 0.1% in their portfolio, and I tell them they're diversified, and they get it. He said the year they come in, when it didn't rain in the Midwest in July and August, and corn prices went to $8, and now I doubled my investment there, and that 1% became 2%, and their 9% target portfolio became a 10% target portfolio. I'm a hero. So he said I have low volatility. If I buy it when the price is low and just sit on it, it's really not doing anything in my portfolio to harm it significantly. And it's surprise to me is going to be the upside. And so that's how you trade ag. Sugar doesn't have quite a significant pattern like that, but the grains, especially corn and soybeans, do. And harvest, all the corn and all the soybeans, all the crops in the northern hemisphere are harvested at the same time in the autumn. And so you can see a seasonal low get put in the charts, in those spot continuation charts right around the first week of October. And so a lot of people keep their eye on it and they allocate it to it then if the price of corn is under that $4, towards that $3.50 level. That's when people say, look, it's a low risk buy. It's dead money when it goes in. There's no dividend on this thing. It is money that's waiting for price appreciation. So people need to understand when they buy it that that's a buy and hold allocation. And when you see it, double or go up close to a double, most people then get out of it. It's an allocation. So it's a tactical allocation. It's not a buy and hold forever like gold or Bitcoin. But there are times when you layer into ags, and that's when you see them trading sideways at the lower historical price range.
That is actually a really interesting point, kind of a cycle of when to buy, when to sell. And I think your individual that you just spoke of, he bought it when it's at about $3.50 to $4 a bushel average, and he would just wait and hold it. It's not money that he needs to pay the rent or anything like that. It's disposable money that he can afford to lose if, anything happens. And I think that is actually really interesting compared to other companies where their cycle might be based on, earnings reports or something of that nature compared to climate, weather, a drought, an oversaturation. And to stay on the climate part, there's a lot of views where when it comes to agriculture, commodities, and so on, that it's not only the climate that may affect production, but also maybe government regulations, and maybe there's a cap. I know some people tell me that, they make more milk than they're allowed to, so they have to dump it, or they may have laid more eggs than they had to, so they had to unfortunately throw it out. How is that in the commodities? Does that also something that is happening?
In the major grains, you don't quite have that situation because they're so big and so global. You don't have that type of intervention. But you did have, the all-time high for wheat was a back-to-back drought in Australia in the early 2000s, and then it was either challenged or exceeded in some weak markets to when Russia invaded Ukraine, because Russia and Ukraine provide the world with more than a third of their wheat. So, what's really interesting about ags is some countries grow everything they need. Other countries grow more than they need and they can export it. And the countries that don't grow enough of what they need. So, for instance, there are only 3 countries in the world that export soybeans in any reasonable volumes, and that's Brazil, United States, and Argentina, in that order. Paraguay does some, but I mean others. It doesn't even blip on the radar. So literally, if you're China and you need to buy soybeans, you can be mad at the U.S. for a while and not buy their soybeans, but you have to buy their soybeans because when Brazil runs out, and Argentina runs out, you've got to go. Because here's the deal: there's not a 1 year or more supply of excess of food. So generally there's about a 6-month excess supply of wheat. There's generally about a 3 to 4 month supply of corn or soybeans. Literally, if there were a total crop failure, you would run out in 3 or 4 months. That's it. It's over. So the reason there's a seasonality in prices is the big pile is on the ground of corn. Let's just say Northern Hemisphere corn. Okay. All the harvest comes in at the same time. Guess what? You and I and everybody else goes and takes a little bit from that pile every single day. Every single day you're using corn, whether you're using fuel or ethanol or you're eating meat, which is the number one. So, the number one use of corn in the world is to feed animals. Okay. So everybody's using corn all the time. Corn starch makes paper. If you're using paper, you're using corn. So all of us are taking from that pile. Well, guess what? Now it's winter, taking from the pile's getting smaller, no corn in the ground. Come spring, pile's getting smaller. You're just putting the seeds in the ground. Come summer, the pile's getting smaller. The corn's not grown yet. It's not harvested. Come autumn, that pile's getting pretty small, and you make it to the end when you can harvest again. The end of autumn when you can harvest, when that corn is ripe and ready for picking. That's why people get scared. So if in the middle of the growing season of whatever commodity it is, it doesn't rain, there's a drought or something happens, there's disease or whatever, that's when prices skyrocket because people realize we could run out. Now, you never run out, okay? It's called price rationing. The price gets so expensive, people just stop using whatever it is. So it's, when people say you're going to run out of food, you're not going to run out of food. It's just going to be really expensive. You're not going to be able to afford it, but nobody runs out of food.
That's actually really cool to say because we're always being scared with, a global food shortage, always talking about that. But as you just said, right, when prices get too high, people will just stop using it, which eventually will bring the prices back down.
And farmers will plant. They call it, fence row to fence row. And don't forget, global warming is really good for crops. It's not bad because
they need the
warm air,
right?
holds more moisture and it rains more, and rain makes grain. There's a reason for that thing. So when you see the news, there's 1 million acres underwater, and all the news outlets call us and they want us commenting on what's going to happen. The price is going to go up. We say it's 1 million acres. The only people affected are those poor farmers whose fields got flooded. We have 500 million acres planted. No one cares. Except the farmer's field got flooded. It doesn't matter. It makes a headline, scares everybody, but it does not affect the price.
Because it's such a small piece of the bigger land use.
Correct. Okay. What affects the price is drought in July in the Midwest. That's all of the big moves that I've ever seen in grains where grains double. That's what happened.
So that's the trigger, the Midwest droughts.
Absolutely.
Okay, and so now a lot of companies, I'm guessing, because of the popularity of agriculture and commodities, are popping up. They're coming out with other ETFs. But for your company, how do you define which company is actually a commodities company, or they're just using buzzwords to maybe attract buyers or attract alternative investors? So how do you pick the holdings for not just your ETFs, but just in general? How do you differentiate a commodity-based company and a buzzword-using company?
Sure. So, our commodities actually hold our ETFs actually hold the commodity. They hold futures on those commodities. So the corn fund only holds corn futures, holds 3 different corn futures all the time. And we try to use the ones that the farmers are using for their hedging so that we're in the game with the professionals. Same with soybeans, same with wheat, same with sugar. We use futures contracts. We actually hold the commodity. And that's why I say this is not, it's not dependent on earnings. You're not going to get a dividend on these things. That's not what happens. We do have one product. It's called TIL. And it's how they're structured, but there's a 40 Act product, and that holds 25% each of corn, soybeans, wheat, and sugar. And the way it's structured, it could issue a dividend if it has positive gains on the buys and sells of the futures inside there. But again, this is not discretionary. We don't buy if we think it's going up and sell if we think it's going down. We just buy. So if $1 million comes into a fund, we put that $1 million to work buying $1 million of that commodity. If it's into a levered fund, we buy $2 million of that commodity. Levered funds, for your audience, that's something we should talk about. They are reset daily to capture 200% of the market move, which means each day they're reset. They're designed for you to double your money that day or get 200% exposure, less fees and expenses and market static. Okay. But by and large, anyone buying and holding a 2x fund needs to understand that unless the underlying price of whatever that 2x fund is holding goes up, that fund's going to lose money that day. If it goes down, the fund's going to lose money. If it goes sideways, the fund's going to lose money. So 2x levered funds, 2x long only funds, which the funds we run are, they only make money when the underlying market's going up. In sideways or down markets, they lose money. That's the way they're designed. We didn't invent the structure. We just put different things in them than other people did. But because you reset to have a 200% exposure each day. So they're meant for day traders. That's what they're. Now, a lot of people buy and hold them. You're not supposed to do that. Read the prospectus, talk to your financial advisor. But, no law says you can't. It is unwise to do so if you are buying and holding for a long term. They're tradable products. That's what levered products are for. They're for trading. They're not for buying and holding.
Okay, well, thank you for that clarification, because there are plenty of ETFs out there that say that they're 2x leveraged, and all they're trying to say is if it goes up by $1, that means you made $2. If it goes down by $1, that means you lost $2.
In one day, yes.
In one day.
That's right. That's
yes.
right.
So it's good to clarify that, because a lot of people may think, oh, 2x levered, that means I'm going to double my money all the time, when really the opposite can also be true by losing double your money as well.
Right, which means the underlying only goes down 50% and you have zero. You lose it all. So people need to understand that.
And that's why I always tell my my audience members, always do your due diligence. Please do not listen to your neighbor. If they're pulling out a stock out there, it's already too late, and it's just, a hype at that moment. And so in the commodity sector, it's a very, very obviously not volatile only, but also a sensitive sector, because a lot of factors can affect it. What type of upcoming, if there are any upcoming, but regulatory changes that might impact the sugar or corn market? And also, a lot of people are saying that sugar should be taxed the same way tobacco and alcohol are. What are your thoughts on that?
Well, I think that's what you watch out for. I think that if I think the whole point of getting away from high fructose corn syrup, I think there are 2 points that Secretary Kennedy wants to make. One, he believes high fructose corn syrup isn't as good for you as regular sugar. And two, I think he thinks most sugar, like we all do, is probably not that good for you. And so, you should limit your intake of it. If they implement policies that make the price of sugar go up, it could, in theory, reduce demand and the price could go down. I just don't see that happening. I just don't see it. There's a difference between tobacco and causing lung cancer and, sugar, if you eat too much of it, maybe being bad for you. Like, I don't know. I just don't know.
Yeah, so, it's always a complicated debate between people. They say, sugar is as harmful, but I think with sugar, it's not, I don't know, maybe it could be addictive. Some people say they are, but I personally would not put it in the same category as tobacco and alcohol.
I don't think in our investing lifetimes, the decline in sugar consumption is going to happen to affect enough. I don't think it's going to matter. Now, it could, because it'll happen quickly. If a lot of companies jump on the Coca-Cola bandwagon, that could create a demand for more cane sugar, which, could affect the price, assuming the rest of the world doesn't step up and just grow more. And they can. But remember, it takes a whole growing season to do that. Yeah. So you do. That's what causes price volatility. You can't just increase production overnight. It's not a factory where you just start working 24 hours. It's a growing season. It's literally cosmic. You have to wait for the warm weather to grow something. So
and that leads me to my next point. What do you think about artificial sweeteners like Splenda and other aspartame? Are they taking a chunk of some of the sugar market, or do you think this is, of course, a better alternative than the corn syrup sugar compared to natural sugar, or do you think artificial should also be out of the equation? What are your thoughts on artificial sweeteners?
Honestly, I don't know. I've never used them. They say they're sweeter, the people who do use them. I don't know what effect they may have had on sugar markets during their development over the past couple decades. So I just don't know. I honestly don't see alternative sweeteners growing that aren't based in honey and maple syrup. I mean, people like natural stuff. That's where everything's heading. I don't see us going more towards artificial anything. I think that most companies target growth for healthy, real stuff.
Personally, I definitely agree with that. I am not an artificial sweetener person. Whenever I need something sweet, I'm either using natural sugars, honey, and those alternatives. But also, when you're looking at the problems that sugar brings, especially in global markets, there's wars, there's natural disasters, there's a whole bunch of things happening. What do you think are some of the biggest geopolitical risks? Like, for example, you said Ukraine and Russia are one of the biggest exporters. Brazil's a big exporter. If one of these countries just went through some, worst case scenario moment, what will that do to the sugar sector
Well, people
or a
always
commodity
need to look.
sector?
Yeah, I mean that's the thing. Look at different commodities. So sugar's made in Brazil and India and Thailand. Those are the big ones. Okay, they dominate the globe in terms of sugar exports. And so if something were to happen in one of those countries politically, where they passed an export tax or they did something that could definitely affect prices. But that's the same for any commodity. Argentina uses its import and export taxes on their grains, especially soybeans and wheat, as a balancer of their budget, as a weapon against farmers to motivate them to do certain things. A lot of countries do a lot of different things, so it's pretty hard now to say a war in the Black Sea is a unique event, not just because it's a war between two parties, which hopefully gets more and more rare and more unique, but the Black Sea is a huge export for wheat. A lot of grains and ags are grown in a lot of different places. It's pretty hard to have a war to wipe out your exports globally of something, especially because the land areas are so vast where things like soybeans and wheat and corn are grown. So, that seemed to be, it's a bottleneck of the Black Sea for that. That's a unique, I think long term short term, look at the China tariffs. Okay. We've seen it before in Trump's first presidency when we were having a trade war with China. China bought all the soybeans from Brazil first, and then they came back to the US. As I explained, they have to come to us. But for, 3, 4, 5 months, whatever it was, the price of soybeans in the US was artificially depressed because of that. Okay, but then it went back up when China came back in buying. So there's opportunity in these little government meddlings and government interventions, and people just have to know it might be a buy opportunity, it might be a sell opportunity. You've got to be watching and paying attention. But that everything is unique. We're just paying attention to commodities. People can sign up for our newsletter. Go to our website, teucrium.com, sign up for our newsletter. We don't harass you. We generally send something out twice a month. And we don't ask for anything. You just sign up. We also have a model which tells people how to allocate if they want commodities exposure. A lot of people say, I would like 5% of my portfolio to be in commodities, but I don't know what to do. We put out a model monthly that tells them the ETFs and weightings to buy. And we don't guarantee anything. It's our best shot at what's a good model. Some of our ETFs are in there, and many of other people's ETFs are in there because we only have grain ETFs in the commodities market. And so we recommend other people's ETFs, or we just put them in weighting in what's called a model portfolio. That's free. People can sign up for it if they're interested. We're here to help.
Yeah.
And go to our website for educational materials.
Definitely. And so, audience, I'm going to have all of Teucrium's information in the description box with the newsletter, because as I said, this is a very alternative sector. I mean, I personally don't have any commodities in my portfolio, and this is something I will 1,000,000% be looking into, because it is, as I always say, diversification always protects yourself, always mitigates risk. And so, Sal, currently, we're nearing a tipping point where investors are not just investing to make profits. They're, looking more at morals, ethics, their values, and so on. What do you think about that? Because commodities is a pretty safe, I would say, ETF sector, because you might have other ETFs that might have defense, and you may not be into defense, or they might have tobacco, alcohol. You're not really into tobacco, alcohol companies. So what is your opinion on people putting their values first instead of just their dollars?
I think it's admirable, and if you can afford to do it, that's great. All of those things tend to underperform over time. But if you don't mind that and you're making a statement with your money, which we all do. I don't shop at certain stores because of whatever they do. It's like all of us do that. We don't buy certain products or we buy other products because of our allegiances to whatever. And so, nothing wrong with that, but do be aware that a lot of the portfolios that tend to eliminate things for whatever reasons, okay, they also tend to underperform. So if your number one goal is performance, you have to think long and hard about that. If your number one goal is, hey, I've got enough, I don't mind if my portfolio isn't a top performer and I want to put my money where my heart is, great, go for it.
Yeah, because I think that seems to be the biggest trend these days with thematic ETFs. People are just choosing themes that they would like, that they kind of closely relate to. Because I know maybe 20, 30 years ago, the original form of investing was 20% treasuries, 30% bonds, and that type of allocation. But now everyone, or a lot of people, are very, very interested in ETFs. And continue talking about ETFs. How does a commodity ETF, especially yours, can it outbeat the NASDAQ 100, for example? Can it beat these broader indexes? Because I know right now, the markets are about 15 to 20% up with all this tech boom. But then if you look at the other sectors, they're just kind of, they're relatively good, but it's only the tech sector that's actually booming. What are your thoughts on the commodity sector amongst the other sectors?
Well, commodities, I view them as a diversifier, okay? And unless you see a special opportunity, like you think a drought's coming and you get long, whatever commodity that is, that's not going to be any anymore. We always say if it doesn't rain in Kansas, people in New York City don't stop eating their bagels for breakfast. That's why the price goes up, okay? And so if you see that happening, if you see it not raining in Kansas and everybody's going to still eat their bagel, at that point, you could have wheat markets outperform a whole lot of other markets. And that's happened before. In snapshots of time, I think you can pick any commodity that when it has a supply shock, because demand for commodities is generally always rising and pretty steady, especially for grains. I mean, grains, so the combined global demand for corn, soybeans, and wheat is either a record or it just misses and it's the second highest every year since 1960. We did the study. Okay, so the demand really only goes up. It goes up or sideways for a year and then goes up again. So if there's a supply shock, the demand stays, the price goes up. So at that point, whatever commodity you're talking about is going to outperform a whole lot of things. When the war broke out, wheat went up, stock market went down temporarily, for a couple of days, you're thinking, wow, I'm a genius because I own wheat. Well, it reversed, stocks are resilient and wheat's going to go back to its cost of production. That's what all ags do. They go back down after their rally to their cost of production because farmers don't get up in the morning and say, oh, I'm going to look out at my dirt and just leave it dirt. They get up in the morning and plant something in their dirt. That's what they do. It's their job. So there's more coming next year. So, the price is going to go back down when the price goes up on ags. Ags go up and down. They're cyclical. You can't just buy them and hold them like stocks. So in that regard, they're not for everyone. And they're certainly not for, a big chunk of your portfolio. They're for diversification. You're going to do better over time. And I'm not giving it financial advice, but you ask anybody, you're going to do better over time owning stocks and bonds than a commodity.
It's a cyclical sector,
it's
right?
a cyclical thing. Other than gold, that always goes up and to the right.
Yeah.
Maybe not as fast as the stocks, but gold's pretty good in that.
And since commodities is pretty much an essential to our lives, I mean, you can pretty much after a few years, maybe a few months, realize how the cycle goes and then kind of bet on when it's on the low, sell at the top, and just kind of go up and down. So we've talked a little bit about the tech sector, but let's talk a little bit more about that. So you have created a crypto ETF. I know 20 years ago, not even, maybe 10 years ago, actually, institutions were not touching crypto. They were like, this is speculation. We don't know what's happening. Then a couple of years ago, BlackRock came out with their Bitcoin spot ETF that gave institutions a little bit more confidence. They're like, okay, you know what? Let's go all in. Then they came out with the Ethereum version. And I think there's a Solana and XRP one being worked out. Can you tell us more about your crypto ETF and what made you jump in as well?
Sure. Well, like I say, we did have that experience with Bitcoin. We had filed for a Bitcoin ETF and we are derivatives experts. And so we're in a bit of a waiting period right now for people waiting for the physical XRP, for funds that can hold the XRP tokens. And so there's this huge demand from the investing population to to get price exposure to XRP. And given that we're derivatives people, we knew that XRP futures were announced by both Coinbase and the CME. They were going to come out, but a bunch of people filed at the same time. Everybody's waiting and watching, and so we said, well, how can we get ahead of this? You have to be first. And I'm a derivatives guy. It's what I've done my whole life. So we structured a derivatives swap that followed the price of XRP based upon because Europe has more lenient laws than we did on crypto listing. There was an XRP ETF in Switzerland, and so we structured a swap on that and listed it in our XRP, our leveraged double XRP. XXRP is the ticker. It's a great ticker on the New York Stock Exchange, and we stuck it in there. And so we were first to market, and that's what matters in ETFs. You have to be first to market. I don't know why. My oil and gas ETFs years ago, they were 2.5 years we had them out, and they beat all the other ETFs in their category, and no one bought them. They only, everybody gets used to the name or the good ticker, and that's it, and you have it. So I knew we had to get out there. I knew we had the best ticker, double XRP, XXRP. So I said, we've got to be first. And we structured a swap and put it in there, and it just took off. And then when futures came, we instantly switched to futures. There's good deep liquidity in there. And so it just took off, and people still can't buy tokens on the stock exchange in an ETF. It still has not been permissioned. It will come. We're convinced it will come in the next couple of months, no doubt. But right now we have the trading product for people who want that aggressive price speculation, and the people really interested in buying the tokens. This fund allows them to get the double leverage, the 2x leverage, or as best close to it as we can get. And so I think that's why it had such good demand. I do think though that when XRP tokens are approved for ownership inside of ETFs, I think those are going to be wildly popular.
I agree. I highly agree. I hear XRP everywhere I go, and I think being first to market is definitely going to make Teucrium, is going to make it, I would say, a household brand, because currently I love my crypto ETFs. Unfortunately, I have not heard of XXRP until now, but I am definitely going to be looking into it, and I'm sure many of my audience members are freaking out right now saying there's an XRP ETF. So
remember, it's leverage. So it's a trading ETF. You sticking that in your buy and hold portfolio.
Exactly. I'm gonna have all the details in the description box, so everybody make sure that this is not the actual token, and it's not a buy and hold moment. It's more of understanding that 2x means what it means, because you can lose a lot, you can also make a lot. So the risk is higher. And so what would you tell someone who's just starting out to invest in commodities? Is there anything they should watch for? Anything? I know we talked about cycles, but is there anything else that might mitigate their risk or help them out, maximize their gains more by investing in commodities for a new investor?
You should probably start with a multi-commodity index. So if somebody wants commodities exposure, if you're going to be a trader, that's different. You go learn about the commodity and trade it, fine. But for people who want exposure in their portfolio, you should probably start with a multi-commodity ETF. And there are a lot of them out there. You can take your pick, look at the charts and see what you like. So then you have all the commodities. I always tell people, most of the people I know started with gold. And they started with a multi-commodity ETF, a little teeny exposure, and then that got them interested. And then if oil's in the headlines, they look at an oil ETF. If corn's in the headlines, they look at a corn ETF. That's up to you. But I would say when you buy these things, if you're just doing it for allocation, a lot of allocators just close their eyes and buy, okay, whatever, but because they're going to hold it for a while. But if you're buying the single commodities, with the exception of gold. And again, this isn't investment advice. I'm telling you what I've done. And that is, you look at the price chart. The price chart will tell you when that commodity is at a support point. And if you look at a long-term price chart, it'll tell you when that agricultural commodity is probably at break even. Okay, because you can see where it dips below a certain level, but then goes right back to it. Metals do that. The metals do that. I mean, just look at them. If you're looking at silver, if you're looking at copper, if you're looking at aluminum, look at all these things that interest you, whatever interests you, and you can see on the long-term price charts where the break-even price is. Everybody in the world, when oil goes below $40 a barrel, people start buying the oil ETFs, it's amazing. Billions of dollars pile in because people all go, it's going to go back to 80 or 100. There's going to be a war. There's going to be something's going to happen, and it's going to go back to 80 or 100. And they buy it and park it. When corn goes below, $4 towards 350, that's pretty much the same thing as oil going under 40. It's not any different. You don't know when it's going to go back up is the problem. It's a timing thing, and you're not earning any money on that money while it's invested. You're just paying your fees to the fund manager for them to hold it for you to create that fund.
And I think that's what perfectly said. And I think a lot of investors should start with multi commodity ETFs so they can get exposure to a variety instead of, and I know Teucrium has a multi commodity ETF. What was the ticker symbol again?
So TILL, TILL,
TILL
has corn, soybean, sugar, and wheat, and tags has, and one's a K1 and one is a no K1. TILL is a no K1 and may or may not give you a dividend. Tags is a K1, which gives you a better tax treatment. And it's, people who know, okay. And it's not a problem to have a K1. And in fact, it could be favorable depending on the tax bracket that you're in. So, those are our multi-commodity funds, but they're strictly ags. And again, you can sign up for our portfolio, our model commodities portfolio, and that has generally a multi-commodity fund in it and a bunch of single commodities. So it keeps you diversified. And again, those aren't all Teucrium funds at all because we don't have ETFs in every sector. So we just recommend what our model says to buy.
Okay, perfect. I'll definitely have that in the description and make sure my audience members definitely check it out. So Sal, thank you for that amazing information and wisdom. But on this channel, we also have a very short segment where I ask you 3 out-of-the-box questions. Are you up for it?
Sure, why not?
All right. So first question, if Teucrium was a person, what kind of personality would it have?
I'm going to say aggressive and cautious.
Excellent. I love that. Second question. What was the most random app that you've downloaded before or recently have downloaded on a device? Some have some people have like a meditation app. Some people have like a sunset app.
I don't have any of those. I'm a boring app guy. I have the parking app and apps that are functional. I don't download apps. I don't. We're really security sensitive, so we don't download apps.
Well, the parking app in itself is also a good one, right? You got to make sure your parking meter doesn't run out.
Yeah, it's fantastic.
And the last question, if you were not in commodities, finance, investments, what totally unrelated career would you have gone into?
When I look back on it, I probably would have gone into maybe forestry.
Ooh, nice.
Yeah.
That's actually a really cool one. So Sal, before we finish off this interview, the last question I have for you is, what are your plans for the future of Teucrium, and where do you see the company in maybe 3 to 5 years?
Sure. Well, one of the biggest things we've done is started a white label division where we will open an ETF for someone else using our expertise because we know what to do. And so if somebody else has a really good ETF idea that can get through all the vetting, we'll help them launch that for a fee. So I think that 3 to 5 years from now, that's going to be an enormous part of our business. We can't figure out what the next ETF is going to be, but a lot of other people can, and we can help them do that. And so that's a big deal. And we likely will come out with more funds. They will they may be target funds, they may be risk mitigation funds, they may be funds that we trade. People are asking us all the time, look, guys, can you trade some commodities for us, or can you trade some crypto for us? You never know. You never know.
And that's the best part about investment, right? You don't know what's going to happen tomorrow. You don't know what's going to happen next year. You just have to make sure you do your due diligence, make calculated decisions, and go from there. So Sal, thank you so much for being here with me today. You have given us some amazing wisdom and expertise advice, especially in the commodities sector. As I said, you're the first CEO and company to be on my channel that specifically targets commodities, and I know my audience members are gonna absolutely love it. So hopefully you can check out the comments once this video comes out. Audience members, I will definitely have Sal and Teucrium's information in the description box. So if you ever have any questions about commodities, check out their newsletter, check out their portfolio builders, any of that, please check them out, because I know I will, because I currently I do have Coca-Cola in my portfolio, or I did, but I don't have commodities, and that is something I really would love to include. So Sal, thank you so much. Is there any last mentions, anything you want to send out there to the digital world?
I do. Be careful out there and know what's important. You know, we're all out here trying to gain our wealth, but your wealth is in your family and your faith. And so, you know, money's third. Remember, money's third.
Money is definitely third. Please don't put money first all the time. So Sal, thank you so much. Audience, this is not the only time you'll see Sal. We definitely want to continue watching the journey of Teucrium, see what they're up to, have Sal back on, tell us more about the world of commodities, what's going on in the world. And so please make sure you like and subscribe. So until the next time, stay ranting.